Hello everyone, welcome to ACCA P6 UK lectures. In this video lecture we are going to look at a past exam question paper. Now we have already finished the inheritance tax, as I said to you in the previous video. So this is our last video lecture of inheritance tax. So we will be doing one question in this video lecture. If you could open your BPP exam kit and come to question number 16 of your BPP exam kit, please. Question name is Counter, and it was examined in 12/2014. So December 2014 it was examined. Question name is Counter. So it is a 35 mark question. It's a big question, typical question 1 of your P6 exam. So it is a 35 mark question. It's a huge question, and whenever you see a question like that, it's a big question. So do not panic. Do not think like it's a huge question and there is information all over. What I'm going to do, how to start and where to start from. So that is the typical thinking of the students. So they found themselves stuck in the question, so they don't know where to start from because it's a huge information, a lot of information in the question. All right. So do not panic. Just read the questions. First of all, we will read the requirements. After reading the requirements, doesn't matter how long the question is. Examiner has always divided the big, huge question into the small chunks. So, and the requirements as well. So there will be few requirements, and then the information will be in the information will be divided into the small chunks of information, which will be relevant to the specific requirements. All right. So it's not that difficult as it looks like. Now, if you could open up your BPP exam kit, question number 16. Question name is Counter. If you have any other exam kit, question name is Counter. Counter, and it was examined in 12/14. Now, if we read the if we read the requirement first. So first of all, it's in the required section. It says, prepare the meeting notes requested in the email from your manager. The following marks are available. So the more information will be in the email from our manager. And that is the typical style of the examiner to ask these questions. So in the first one, it says capital transaction. So there are 4 marks for inheritance tax and 4 marks for capital gains tax. And in part B, it says budgeted trading loss for the year ended 31st of March 2019. And in this year, so 31st of March 2019, which tax year is it? That is tax year 18/19. And if it says offset of the trading loss, and in the 2 it says further tax payments of the loss if the loss is carried forward. In requirement C of the question, it says reporting of the chargeable gains, and in part D it is about value tax, and professional marks will be awarded as well. Now, where the question starts, it says Counter, and then the extract from the memorandum. Then the capital transactions are given. Then the Counter business information is given. Extract from an email from your manager is given, in which we will be given more information. Excuse me. Now, if you just read the requirement C again, please. Reporting of chargeable gains. Now, if we come to the second page of the question, where the extract from an email from your manager. So if you see part C here, it's a reporting of chargeable gains. Now in this one it says the Counter does not intend to report his chargeable gains on his income tax return, as he believes that the tax authorities should be able to obtain this information from other sources. Explain the tax implications, explain the implications for Counter and our firm of Counter failing to report the chargeable gains to HM Revenue and Customs. Now, when we studied the self-assessment chapter, I told you that this is a typical ethical question which is examined in almost every sitting. So there are 5 marks in every sitting which are for ethics. So this question is relevant to ethics, and it is a standard question which is examined in almost every sitting. So the client is hiding the information from HM Revenue and Customs. He is thinking that I do not want to disclose the capital gains information to HM Revenue and Customs. So eventually he want to hide the tax. He do not want to pay the tax. So the answer of this question would be that we will tell our client that you should disclose this information about capital gains tax to HMRC, because HMRC otherwise will not be able to know it from other sources, like client thinks. So client is just playing up. So he knows that HMRC won't know from other sources. So he's just stating to us that I do not want to disclose that HMRC will know from other sources anyway. How can HMRC know when you are not telling them? right? So you must tell the client that HMRC won't be able to know the information if you do not tell them. And if you keep hiding that, then you will have to pay penalties and interest as well, and penalties and interest will be on the potential lost revenue. All right, so you will have to tell them the consequences. And after that, then if the client agrees on that, that's fine. However, if the client does not agree, you will have to say that if you do not agree with the disclosure, we will have no option other than to cease acting for you. And if we cease acting for you, we will have to inform to HMRC that we are no longer acting, we are no longer representing you. However, we will not tell them the reasons about why we are not acting on your behalf. But even though we will not tell them the reasons, but HMRC will already have an idea anyway, so that why all of a sudden an accountant has stopped acting for a client. So they might start investigation. All right. Now we will have to tell them the consequences for them and for our firm as well. So for our firm, it's our duty to act professionally and with integrity. So we cannot represent a client who is hiding the information, hiding the source of income from HM Revenue and Customs, because it is against our profession. And for you as well, it is a criminal offense if you are avoiding the tax in an illegal way. So tax evasion is illegal and it is a criminal offense as well. So in extreme cases, we might have to inform the money laundering reporting officer. All right, so that is a typical answer of this question. So it is a standard question which is normally examined in the P6 exam about the ethics. All right, so that's the way to answer it. Now, out of that huge question, how I started the question. So first of all, I read the requirements, then I chose the requirements. So there were lots of requirements. Then I chose which one is easier to answer. Of course, I have already read the question. But what you would do is that you will read the requirement, then you will just skim through the question to see that which information is for which requirement. Of course, there are few requirements and there are few chunks of information as well. Like in this question, first of all, extract from memorandum, capital transactions, then business information. After that, extract from the email from your manager, and in that as well, capital transactions, information about the losses, and then chargeable gains. All right, so I took the information about the chargeable gains. So I don't know anything about the rest of the question. So I I just picked the information. I just studied the information from the chargeable gains, and then I read the requirement and I answered that part. All right, so that this part is already done. Right then, so that was part C of the question. Now, if we look at part A, requirement A of the question, we won't be answering the VAT for now because we haven't studied the VAT yet. So in part A, it says capital transactions, inheritance tax, and the capital gains tax. So we'll read the information about inheritance tax first. If you read the email from your manager, so we will again move to the email of our manager, in which he says that capital transactions, and just before the capital transaction, it says, please prepare the notes for use in a meeting with Cantor. The notes should address the following issues. For capital transactions, inheritance tax, first of all, availability of small gift exemptions in respect of Cantor's gift to his nephews. Now, Cantor has gifted a few amounts to his nephews, then we'll have to see that if the small gift exemption applies or not. Now, we don't know what is in this question, but we know general rule about the small gift exemptions. Whenever we are giving £250 in one tax year for one receiver, one donee, then up to that amount is exempt. However, if it exceeds, then the whole amount is going to be taxable. All right. So if it is £250 per tax year per donee, it is exempt. If it exceeds, then the whole amount is taxable. We know that rule. Now let's read the information what is given to us in the question about this topic. Now extract from the memorandum. Now we will read the question now. Now just pause the video here and read this bit which is extract from the memorandum. Just read this bit for now. Just pause the video and read it, please. Now I hope that you have already read it. Now the information which we were searching for is given on 5th of October 2016, where it says Cantor give 400 to each of his nephews. Now each of his 3 nephews, he has given £400 to each of his 3 nephews. We know that up to £250 is exempt per tax year, so it is fully taxable because it exceeds that amount. Now, while answering this part of the question, we'll have to write in a commentary style that small gift exemption only applies where the amount of gift is £250 per donee per tax year, then it will be exempt. If it exceeds that amount, then it is whole amount is going to be taxable. So in this case, £400 given to each of his 3 nephews will be wholly taxable, because small gift exemption does not apply in this case, and you have earned the full marks, right? So easy peasy. Right then, coming back to the extract from email from your manager, inheritance tax. So if we have done part 1 of it, where it says availability of small gift exemption in respect of the content's gift to his nephews. Now in part 2 it says calculation of potentially exempt transfer on 1st of February 2018 after deduction of any available exemptions. Now on which date? It says 1st of February 2018. So going back to the extract from the memorandum, on 1st of February 2018 he's saying, so let's see which gift is given on 1st of February 2018, and we have to calculate the potentially exempt transfer on that. Now on 1st of February 2018, on this date, when the 8 acres of land were worth £290,000, Cantor gave 2 acres valued by an independent expert at £100,000. So Cantor gave 2 acres for £100,000 to his son. Capital gains gift relief was not available in respect of this gift. Now 8 acres of land, just before giving the gift, the value of 8 acres was £290,000. So we have to calculate the diminution in value. You remember what the diminution in value was? Diminution in value means that while calculating the inheritance tax, while taking the value, it is not what we are transferring as a donor, it is what we are losing as a donor. All right, so we'll take the value before transfer, which is £290,000, and what is value after transfer. So whatever the difference is, that is our potentially exempt transfer. Right, so in this case, £290,000 is the value before transfer, and it says that 2 acres of land is given to his son. Capital gains tax relief was not available, and on the 2nd February it says Cantor sold the remaining 8 acres of land at auction for £170,000. So that is the value after transfer, right? So the value before transfer was £290,000. Value before transfer was £290,000, and value after transfer was £170,000, right? And the difference is, whatever the difference is, that is our potentially exempt transfer. All right. Now we will apply which tax year is it? 1st of February 2018. That is tax year 1718. So we will apply one annual exemption of £3,000 against this. So that is our annual exemption, which will be applied against this year, against this gift. Now the previous years, if we look at the previous year, now the previous year was which was the previous year? Now the previous year was 1617. Yeah, 1617. So the previous year was 1617. Now we can use the brought forward annual exemption as well. So we can use 2 annual exemptions, one for current year and another for previous years as well. So there are 2 annual exemptions. So we can use the brought forward annual exemption as well. But please remember, if it is unused. Now the previous year's annual exemption must have been used against the £400 to his nephews first, all right? Because if it would have been small gift exemption, then we would not have used the annual exemption. So because it was not small gift exemption, so the previous year's £3,000 annual exemption would have been used against this gift first. So it was £400 to each of his nephews, and and there were 3 nephews, so £3,000. Yes, so 4,400 times 3, £1,200 will be deducted out of the £3,000. So the remaining unused annual exemption is £1,800. So £1,800 will also be used against this year. So in this year we will have 2 annual exemptions: £3,000, which is for current year, and the previous year's unused is £1,800. So we can use that one as well. All right. So altogether, 4,800 will be used against this year. All right. So which will reduce our which will reduce the value of our potentially exempt transfer. So that would be the value of our potentially exempt transfer, and I think it was that's what it was asking in the question. So let's read the requirement again. It says what the manager is asking us to do. So it says calculation of potentially exempt transfer on 1st of February 2018 after deduction of any available exemptions. Yeah, that was asked, so we have done that part as well, right? So we have done the inheritance tax so far. Now let's do the the capital transactions part 2, in which it says calculation of Cantor's capital gains tax, capital gains and capital gains tax liability for the tax year 17-18. All right, so we'll have to calculate the capital gains and capital gains tax liability for the tax year 17-18, and again it is tax year 17-18, so we'll have to see the information. All right, now 1st of February 2018. 1st of February 2018, that is tax year 17-18. Did I say 18-19 earlier? I can't remember. So anyway, it is tax year 17-18. So on excuse me. So on 1st of February 2018, on this date, when the 8 acres of land was worth £290,000, Cantor gave 2 acres of land valued by independent export at £100,000. All right, so we'll have to calculate the capital gains on this date and on the next date as well, because there are 2 transfers, right? So let's calculate the capital gains then. So that is 2 acres of land, so that is capital gains tax. Capital gains tax. So 2 acres proceeds, and 2 acres proceeds are how much? £100,000 as given in the question, and then we'll have to deduct the cost out of that. So we will do working 1 for the cost. Now, how to calculate the cost? It is a partial disposal. If you remember, we have studied in our capital gains tax partial disposal. All right. Now, how to calculate it? So we'll do the calculations here. So let's calculate the cost, and that is our working 1. And in the cost, if you see how much was the actual cost of that. Now that is the proceeds of 2 acres of land. Now this 8 acres of land was inherited. Now when was it inherited? On 1st of November 2016. If you see that date, it says Cantor inherited 8 acres of land from his uncle. Cantor's uncle has purchased the land for £70,000 in 1999. So that is what he purchased for. But when Cantor inherited, the value was £200,000, and the land does not include any residential property. So when he inherited, the value was £200,000. So he'll take actual value £200,000 when he inherited, multiplied by how much he sold for. He sold for £100,000. So the portion he sold, £100,000, divided by the amount, divided by portion he sold, £100,000, plus portion he retained. Now he sold 2 acres of land, and what was the value of the remainder? Remainder part was valued at £170,000. So the value of remainder part will also be added in this one. So plus £170,000. All right. So that is the value. So let's do it on the calculator then. 4074. So that is 74,074. So that would be the cost, which would come here, 70,074. Right, which would give me the gain of how much? So let's see the gain. Now if we deduct this one out of this one, so less £100,000, 25,926. So if I put gain here, now the gain is how much? 25,926. Right, so that is a gain on this asset, which was transferred on 1st of February. Now the remaining part is also transferred, remaining part is also sold on 2nd of February, so we'll have to calculate the capital gains tax on that asset as well, because we have to calculate the total capital gains tax. Right, so let's see then on the second asset as well. If we move, let me see how much was it sold for. Now the second remaining part of the remaining part of the land, which was 6 acres of land, it was sold for £170,000. Right, so 6 acres of land. If we take the proceeds, that is £170,000. Of course, we'll have to deduct the cost out of that. Now again, cost would be working 1. This is the same working, so now this time we'll take £200,000, the same amount. Why? Because it is the same asset, right? So £200,000 times £170,000, that is the cost this time, cost of what we are selling, and divided by £270,000. So 100,000 plus 170,000. We can do like that as well, or out of that £200,000 we can deduct this amount, 74, then the remaining amount is going to be exactly the same like we do with this formula, right? So let's do it on the calculator with this formula. So 200, just give me 1 second, 200,000 times 170 divided by 270, 125,926. That is 125,926. So that's 125,926. Right? Now, if we take 125,926, this amount, 125,926 plus 74,074 plus 74,074, so it is going to be exactly total amount £200,000. All right, so that's why we can do like this with this formula as well, or we could have simply deducted this amount out of the £200,000. It is exactly the same thing. Now, if we deduct this amount out of that, that would be our capital gain on this figure, £170,000 less 125,926. So that is 44,074. So 44,074. And if we take both of them plus 25,926 is £70,000. Right, so that is our chargeable gain. We'll have to deduct the annual exempt amount out of that. So let's annual exempt amount less annual exemption, and it would be 11,300 for our current tax year. That is for capital gains tax purposes. Now let's see what is the remaining amount. Let me do it on the calculator. So £70,000 less 11,300, 58,700. Now that is a taxable gain. Now in that we have to apply the appropriate tax rate. Now up to the basic rate band it is 10%, and above basic rate band it is 20%. Now in order to see that what tax rate to apply, we will have to see in the question if he has got any other sources of income. Remember that tax bands will be used against income tax first, then will be used against the capital gains tax. So we have to see if if he got anything which is subject to income tax. Now if you see the information just before the email from your manager, there is information about the business on page number 25 of your PPP kit. Now this information is about the business. Now if you see the which tax year is it? Tax year 17-18. Now the tax year 17-18, in the tax year 17-18, which is the year ending 31st of March 2018, that is the year ending for his business. Now he had sales of £67,000 and deducted the expenses of £8,000. Now in this year, at the end, if you see, that is a tax adjusted profit on which he paid 14,300 tax as well. So he had £59,000 of profit, which means he's not a basic rate taxpayer, he's a higher rate taxpayer. So that's why we'll apply the tax rate of 20%. So chargeable gains tax, chargeable gains tax at the rate of 20%. Now if we apply 20% on that, so it will be how much? Let's do it on the calculator this time as well. So it is a 58,700 times 20%. So that would be £11,740. Right, so that is our capital gains tax. Right, so we have done part A of this question, and we have also done part C. So in part A there was inheritance tax, which I've already done. and we've done the capital gains tax bit as well. Now inheritance tax I've just told you because I thought there is no need to write it down because it was so simple. Now we've done the capital gains tax bit as well. So if we read the requirements, so inheritance tax was 4 marks, and capital gains tax was 4 marks as well. And if you see the chargeable gains tax, that was 4 marks. So altogether, so far we've secured 12 marks, and there hasn't been any difficulty at all. Now if you see, this knowledge was exactly of F6 knowledge. So there wasn't anything technical in this one. It is exactly the same knowledge which we have seen at our F6. And the small gift exemption, that is also easy, and the potential exempt transfer, that was so easy as well. So there wasn't anything technical so far, if you see. However, examiner will give the question which will be which will have more information, of course, which will look difficult. Right? Now coming back to the question, if we read the requirement B, it says budgeted trading loss for the year ended 31st of March 2019. So we have to see the loss, and in first requirement it says offset the trading loss, which is worth 10 marks. So if you come to the extract from the email from our manager, it says in the part B that budgeted trading loss for the year ended 31st of March 2019. In first requirement it says calculations with brief supporting explanations where necessary of the tax which would be saved in respect of the offset of the trading loss for the year ended 2018-19. So we have to offset the loss, offset the trading loss. So trading information is given to us, which is the business information. We have been making some profits. Now there could be a loss in one of these years, and we have to set off that loss. And the loss is for the tax year 18-19. Now if we set that loss as soon as possible, or if we carry forward that loss, what would happen in that case? A brief evaluation of your findings and relevance of counter of the £50,000 restrictions on offsetting of the trading loss. Now there won't be any restrictions at all if we are setting off our trading profits against the trading loss of the same trade. However, if it is not the same trade, then of course there will be restriction on that. In this case, we'll have to see that if it is a same trade or not. Now, if we read the requirement about the business, information about the business, it says Cantor's business. Cantor's business provides delivery services. The majority of customers are members of the public. Cantor is not registered for value tax purposes. Recent actual and budgeted results for the business are as follows. Now, for actual results for 2017 are given. Then the year ended 31st of March 2018. So year ended 31st March 2018. Which tax year is it? Tax year 17-18. And the next year, which is budgeted information of 2019, so that would be tax year 18-19. So there is a loss in the tax year 18-19, and just beneath that it says in the year ended 31st of March 2020, now which is the next year, and the year about which we haven't got any information, no capital allowances will be available to counter. With the exception of capital allowances, the results for the year ended 31st of March 2020 are expected to be the same as those for the year ended 31st of March 2019. Now, he hasn't given us any information about the 31st of March 2020 year. However, he has told us that there won't be any capital allowance in that year. Apart from capital allowance, all the information will be exactly the same like 2019 year. So we know that sales will be £98,000, expenses will be £13,000, so the remaining amount is £85,000. There will be adjustment for the tax purposes of £4,000, and there won't be any capital allowances, so the total will be £89,000. So there will be tax adjusted profit of £89,000 in the tax year 1920, right? So we can calculate that. Now, because there is a loss, budgeted loss in the year ending 2019, in the year 2019 of £68,000. Now we have to. There are two options. We have to relieve it as soon as possible, or we have to carry forward. So we have to see that which one is better. Now, if we read the email from our manager, it says calculation with supporting calculations where necessary of the tax which would be saved in respect of the offsetting of the loss. Now we have to see that how much tax we will save by offsetting the loss. Now we know that loss can be set off against current year, against current year's trading profit and current year's general income, and then we can set it off against previous year's trading profit and previous year's general income as well. Now in the current year, he has got loss of £68,000, and if you see the information about Cantor, extract extract from the memorandum. In that you have already studied that. Now it says Cantor's only income consists of the UK property income of £5,000 per year. It does not have any financial cost in relation to this property business income. So every year he will have £5,000 property income. Now current year as well, in which there is a loss, the year 18-19, there is a loss of £68,000. So we can set it off against the general income because we haven't got any trading profit anyway. So the only option in the current year we got is we can set it off against the general income, and general income is only £5,000 property income. Now that will be covered by the personal allowance of whatever, the 11,500 anyway, right? So I just forgot the personal allowance, how much it was. Anyway, so it will be covered by the personal allowance anyway. So there is no need to set it off against the current year now, because we won't be saving any tax. Now another option is we can carry it back in the previous year. Now in the previous year we'll have to see that how much is the general income. Now in the previous year there is a profit of £59,000 if you see, so we can set it off against £59,000 against that amount, and also there would be property income as well, a property income of £5,000. So 5,000 plus £59,000 is equal to £64,000. So we can set it off against £64,000 in the previous year. Now there will be personal allowance as well in the previous year. However, while setting off the loss, we cannot do like that I want to set off just before the personal allowance. We cannot do like that. Whenever we are setting in the previous year, the personal allowance will be wasted. So whenever we are setting the loss, we cannot reserve the personal allowance. Personal allowance will always be wasted, right? So we cannot do like that I want to set off the the loss, but I want to keep the personal allowance as well. So we can't do like that. So the personal allowance will be wasted, although they will be available in the previous year. So the personal allowance will be wasted. However, £59,000 in the previous year and the £5,000 the property income as well. So that amount, the whole amount, can be set off. All right. Now, if we set it off against the previous year's, general income, how much tax will we save? Now the tax liability is already given to us of the previous year anyway. Now if you see the actual results of 2018, now it says that actual results of 2018, it is at the end the liability is given, which is 14,300. So we would be saving that much of income tax liability if we set off against the previous year. All right. Now that is the amount which we will be saving. Now if you have observed that the total loss was £68,000, out of which how much have we set off so far? We have set off £59,000 plus 5,000. So total amount which we have set off so far is £64,000. Now still we have got £4,000 of loss to set off. So we can still set off £4,000 of the loss. Now how can we set off? Now after setting off against the general income, we still have option to set off against the capital gains tax of the previous year. Now we have calculated the capital gains tax without the relief of the loss. Now we will have to see that how much would be the capital gains tax if we set off £4,000. Now if you see here, that is £70,000 of chargeable gain. If I calculate it here and set off the loss, so that is our chargeable gain, and chargeable gain is of how much? £70,000 is our chargeable gain, and the amount loss set off would be how much? Loss would be £4,000, which we can set off because that is the remaining loss. The remaining amount is going to be £66,000, and on that £66,000 we'll have to apply the 11,300, the personal allowance, the annual exemption. And if we deduct 11,300 out of that, let me see how much is it, the remaining amount. So £66,000. So remaining amount is 54,700. Now what we have done is basically we have set off our loss against the general income, right? Haven't we? So we have already done we have already set off the loss against the previous year's general income anyway, which means that we will not be paying any tax in the previous year on the general income. So which again tells me about another thing, that we haven't used our basic rate band, have we? When we have set off the loss against the general income, which means we will not be paying any tax on the general income, which eventually means that we will not be using our excuse me, we will not we will not be using our basic rate band as well. So that's why, in order to calculate the capital gains tax here, so on 54,700, so up to 33,500, which is the basic rate band, that would be at the rate of 10%, and remaining amount 54,700 less 33,500. So whatever the remaining amount is, on that it would be at the rate of 20%, right? So it would be 3350 on this one, and how much would be on this one? Let me see on the calculator again. Just give me 1 second. So that would be 54,700 less 33,500, 21,200 times 20%, 4,240. So that is 4,240. So the total capital gains tax will be 4,240 plus 3,350. That is 7,590. Right? So that is our capital gains tax of 7,590. Right, so that is our capital gains tax of 7,590 under this while setting of the loss. So we have set up the loss. So our capital gain, if we set up the loss 4,000 pounds, our capital gains tax would be 7,590. Now that is our capital gains tax if we set up the loss. However, if we do not set up the loss, capital gains tax would be 11,740. So whatever the difference is, 7,590 and 11,740. So whatever the difference is, so if we deduct the the 7,590 out of that, so 7,590. If we deduct this amount out of this one, so whatever this figure is, that is saving on capital gains tax as well, because our capital gains tax has reduced by setting of the loss. Now 7,590 less 11,740, so that is 4,150. So that is our saving on capital gains tax. So how much was saving on income tax? So that is given to us in the question anyway. So the income tax liability which we saved was how much? Income tax liability that which we saved was 14,300. So 14,300 income tax saved, plus 4,150 plus 4,150 is a capital gains tax saved. So that is the total saving if we set off the loss against if we set off the loss as soon as possible against the previous year. So whatever this total is, that is a set of that is a saving if we set off the loss as soon as possible, right? Right then, so coming back to the question requirement, it says in part B1, loss as soon as possible, relieve the loss as soon as possible. And in the 2 it says loss is carried forward for the future year. Now if we carry forward the loss in the future year, we know that we have the loss of 68,000 pounds. We can set off against future year's profit, because in the future year we know in the next year there won't be any capital allowance. So our income would be 85,000 pounds plus 4,000 pounds. So our income would be 89,000 pounds. So we can set off against the next year this which amount? This loss of 68,000 pounds. All right. Now for next year we will have to see that how much would be our income tax liability if we set off the loss, and how much it would be if we do not set off the loss. All right. Now I haven't got space here so that we can do it on the board as well. It's not so technical. So for the next year, which is the year ending on 31st of March 2020, we will have to do 2 calculations. So one calculation would be where we will assume that we are not relieving the loss of 68,000 pounds, and another calculation would be where we are setting off the loss of 68,000 pounds. So what would be the difference of income tax liability? So if we assume we are not relieving the loss, so we'll take our income. So our income is going to be how much? 85,000 pounds plus 4,000 pounds, which is 89,000 pounds our income, plus 5,000 pounds property income as well, which is average. So altogether 89 plus 5,000, altogether 94,000 pounds would be our income. We are not relieving the loss. Then we'll have to deduct the personal allowance out of that. After deducting personal allowance, that is our taxable income. So up to the basic rate band, it will be at the rate of 20%, and above basic rate band, it will be at the rate of 40%. So that is how we will calculate if we are not relieving the loss. However, if we are relieving the loss, again our income would be 85,000 pounds plus 4,000 pounds, because there are no capital allowances, so our eventual amount is 89,000 pounds. And we also have the property income, so we'll add 5,000 more pounds. and total amount is going to be £94,000. Now on £94,000 on £94,000, £68,000 we can set off because it is a loss, so we are setting off the loss. So the remaining, against the remaining amount, we will deduct the personal allowance, and whatever the remaining amount is up to the basic grid man at the rate of 20% and above basic grid man at the rate of 40%. So by doing the calculations in both ways, relieving the loss and not relieving the loss, we will see what is the difference between the tax liabilities. So whatever the difference is, of course the tax liability will be lower when we are relieving the loss. So that would be the saving. The difference between these two calculations would be the savings if we carry forward the loss. Alright, now of course if we are carrying forward the loss, we have made an assumption so that we will be profitable in the future, but we are not sure that if we will be profitable actually or not. Alright, so you must communicate that in your answer, because that is a budget which is given to us. So we are not sure that whether we will be profitable in the future or not. Right, so that's done as well, and and in the part B2 it says, on the assumption that the trading loss is carried forward and that Contra wishes to maximize its cash flow positions, prepare a schedule of dates and amounts of payments on account and balancing payments of Contra would expect to make post 1st January 2019 in respect of the tax year 2017-18, 18-19 and 19-20. So what is the I told you that in the income tax and while making the tax payments, so we'll be making three payments. One would be our during tax year, so whatever the 31st of January is during our tax year, so it would be 3 months before tax year. So for our current tax year 17-18, so our current tax year starts on 6th of April 2017 and it ends on 5th of April 2018. So whatever the 31st of January is before end of the tax year, which would be 31st of January 2018, so we will make one payment on account on that date. Now on that date we won't be able to know that how much is our tax liability, because we are within our tax year. So that would be 50% of the previous year's tax liability. So that is one payment on account. Another payment on account is 31st of July after the end of tax year, so 31st of July 2018 for our current tax year. And the final payment would be the balancing payment, so that would be 31st of January after the end of tax year, so 31st of January 2019 would be the balancing payment. Now there are three payments. Now it asks that if we carry forward the loss, what would be the payments for the tax year 2017-18, 18-19 and 19-20? He only need the dates after 1st of January 2019. So on 1st of January 2019 there would be balancing payment of tax year 17-18. For our tax year 17-18, the balancing payment will be paid on 1st of January 2019. So the balancing payment would be how much? Now on balancing payment day, we will have to see how much was the previous year's tax liability, which we have paid already, and how much is current year's tax liability. So whatever the difference is, that would be the amount which we have to pay to HM Revenue and Customs, along with the capital gains tax liability. So for our current tax year, the liability is 14,300, whereas for our previous tax year it was 8,400. So whatever the difference is, that is the balancing payment which you have to pay on 31st of January 2019, right? And along with the capital gains tax payments as well. And for tax year 18, 19 and 19, 20, there won't be any payments on account and taxable payments on account and the balancing payments, because there was a loss, so we will not be making any payments. Right? Alright, and for the tax year 18, 19 and 19, 20, he will not have any taxable liabilities for the tax year 18, 19 and 19, 20. Why? Because we have already made an assumption that we are carrying forward the loss. So if we are carrying forward the loss, of course, there won't be any tax liability in the tax year 18, 19 and 19, 20. So we can write to HMRC that because we expect to have no liabilities in the future, we do not want to make any payments on account. However, if your judgment is wrong, then you will have to pay penalties. Right, so that's it. I think there isn't anything else left in this question. So just go through this question again after finishing this video lecture. Just do this question yourself again. So just writing as well, not just the calculation bit, the way I told you the commentary as well. So you'll have to write that down as well. Now that's end of our inheritance tax. The questions which you have to do, if you want to write down, please, question which you have to do as part of inheritance tax and capital gains tax. As I said, there will be same questions which involve both IHT and capital gains tax. So you must do the practice of these questions. So all the questions which we have done during our lectures, along with this lecture, this question as well, and all the questions which we have done in capital gains tax and IHT, so you must do them questions. And on top of them, there are these questions which you have to do. Question number 14, please. Question number 14. Question number 17. Question 14, question 17, and the last question is question number 19, please. Right, question 14, 17 and 19. So that is your homework for capital gains tax and IHT. That's it for me. That's it from me, and I will see you in the next video lecture, and then we'll continue with our corporation tax. Goodbye.